Hi, Adam Hindmarch from Prospa Property Advisory, and today I'm joined by Michael Zarella from MasterTax. Michael, thanks for joining me.
My pleasure, Adam.
Okay, so Michael, you're a very experienced accountant, and it is tax time, which is probably the best time of the year for property investors. So, hoping you might be able to share some of your wisdom with some of our clients and give us a few tips.
Sure. We've been servicing clients, individual clients involved in rental properties for quite some time now. So we've got a fair bit of knowledge on tips that you can take away to help you with maximising your benefit on your investment property. One of the main things is keeping records is so important on all of your expenses, especially expenses. If you've got a property managed through an agent, then a fair bit of your record keeping is done for you, and your agent will probably provide an end-of-year summary, include all things that they look after and manage for you, but things that are outside of their management, please be sure to keep your records. Obviously, things like council rates, water rates, you get a quarterly notice, keep those. The biggest thing, and funnily enough, that clients leave out and don't think of is retaining their loan statements, so we can determine the interest that they're paying on their mortgage. That is the largest expense and probably the most important expense. So please keep all your bank statements and bring them along when you sit down to do your tax with your accountant.
So if we can just clarify there, particularly with the banking. So what component of your repayment is tax deductible on the loan repayment?
That's a very good point, because often people calculate, the cost of running their rental property based on their interest, principal and interest monthly repayments. But the only portion that's deductible is the interest component. I'm not sure that there's too many interest-only loans these days. There still may be. Makes it easier. Your loan repayments is the interest component, but these days it's mostly interest and principal, so it's the interest portion, and obviously it's important to have your bank statements to know what the interest portion is to be able to claim the correct interest amount.
Okay, cool. So as an accountant, you can work out from somebody's statement the amount of interest that they're paying as opposed to the amount of principal that's being paid down.
Correct.
Okay, so that's a good tip. Great. All right, let's move on to the second tip.
Second tip is if you don't have a depreciation schedule already, so if you don't know the actual cost of the building of your rental property, or if you weren't one of the lucky ones that owned a rental property before the new rules regarding second-hand plant equipment. Plant equipment and special building write-off only apply to new properties. It does apply, so special building write-off also applies to properties that are 25 years or less, so not older than 25 years. So a depreciation schedule is important because it provides a tax deduction for an intangible expense. So all your other expenses require physical payment, and it's affecting your cash flow, whereas depreciation expense is intangible. So it provides a tax benefit in that you can claim a deduction, and you haven't physically had to pay for that, where it doesn't affect your cash flow. So that second tip, if you don't have a depreciation schedule prepared, ensure you have one done. Unfortunately, it will require a quantity survey to prepare that for you if you don't have the actual cost of your build and plant equipment.
Yeah, and that's a pretty good tip, because, and just to put depreciation into perspective for people that don't quite understand it, so that's, you've got the value of the property,
yes,
just through general wear and tear depreciates or goes down in value.
Correct.
So, and the tax department allowed you to claim that as a tax deduction, that depreciation.
Correct.
Yeah, and there were two different types that you touched on there. One which relates to the building, the structure itself.
Yeah, special building write-off is the building.
Yep.
Now that's claimable over either 25 or 40 years, and then the plant equipment is on a more accelerated basis, and it may all be claimed over shorter time span, probably within 10 years, depending on the item.
Yeah, and that's what we tend to see with brand new properties. You're getting the maximum depreciation, that sort of first 1 to maybe 5, 7 years, where you're getting some really good money back in your pocket through depreciation.
Correct.
Great tip, thanks. All right, so let's move on to tip number 3.
Yeah, tip number 3 is, and I've probably touched on it in the first tip number 1 and the tip number 2 is obviously we want to minimise our tax, and probably the main reason people embark on a rental property is to to negatively gear. And for those of you who understand negative gearing, it enables you to claim a deduction of your rental property loss against other income such as salary and wage or business income that you might have. That'll definitely provide the ability to minimise your tax.
Can I just clarify there, like negative gearing, like people think that negative gearing means that you're running your property at hundreds of dollars a loss per week, month,
Sure.
whatever. That's not always the case though, is it?
No, so there's 2 things to consider. Negative gearing means on paper it runs at a loss, and that will happen if you've got your depreciation schedule prepared, because you're including a fair bit of expense there that isn't you're not physically incurring that expense. So on paper it's a loss, but from a cash flow point of view it may not necessarily be at a loss. So when you're offsetting that loss against your assessable income, it allows you to access a tax refund, which obviously minimises your tax, but also can go back to funding your property or take a holiday.
Awesome. All right, so just clarifying there, you're not actually out of pocket, but by the time you've claimed all the other little deductions and bits and pieces along the way, at the end of the year, on paper it actually shows that you're out of pocket, and you could be getting that refund back from the tax department.
Correct.
And going on that holiday, or as I tell my clients, put it back into your mortgage, pay your mortgage down.
Yeah.
But
Good advice.
Good advice.
Good advice.
Okay, we'll move on to our next tip, and this is the one I'm sure you get asked quite a lot. What are the ATO looking at with property investors?
Yes. So some recent changes that came into effect from the 1st of July 2020. 19. So it actually affects the 2020 financial year. So the early stages of a newly built rental property will usually start off with a block of land, the purchase of a block of land, and before you get to a point where the property is complete and you're able to put a tenant in the property to start, who will start paying rent, there's a year or 18 months or possibly 2 years period before that happens, and previously you were able to claim the interest cost on your mortgage for the purchase of the property, rates and taxes, and effectively any costs leading up to the property being available for rent. Unfortunately, you're not able to do that as of the 1st of July 19, and all those costs until the property is complete available for rent will have to be capitalised. So you'll need to maintain those records, and you'll be able to use those as a tax deduction when you sell the property to reduce your capital gains.
Okay, so putting that into perspective, and this one will catch a lot of people out because a lot of people have been claiming interest on vacant land ready to start building. Correct. Or an off the plan purchase. They've put a deposit down and were claiming interest on that.
Yep.
So until the property is now ready for tenanting, you can't claim any tax deductions. Correct. Okay. But that carries on until you sell that property at some stage further down the track. So if you put $10,000 worth of interest payments in up front, that will carry over to offset the capital gains once you sell the property further down the track.
In the future, yeah.
Okay, cool.
And I think that rule came in simply because if there was an intention of building a rental property and for it to be income producing, then that gave you immediate access to claim the deduction. So an intention was a little bit loose, and if that intention changed, like before you get to actually build a property on the block of land, then there's no requirement to go back and amend your return to take out the deduction you've claimed. So yeah, that's what they've moved towards. So vacant block of land until there's a house available for rent and a tenant moves in, or not necessarily a tenant moves in, it's got to be available for rent. So listed with an agent or out in the marketplace looking for a tenant from that point, all expenses are deductible.
Okay, cool. That's one thing to watch out for. Any other things that you think the ATO might be looking at with property investors this year?
Yeah, look, targeting short-term rental homes or holiday rental homes. So they're very, very keen to get an understanding of how accurate people are keeping records in terms of private apportionment. So it's probably more applicable to holiday rental properties where people use the holiday home for themselves as well as put it out for short-term accommodation. So, you know, things like Airbnb, or it might be their personal home and they're renting out part of their home or some of their home or even all of their home. They might move out while they're getting people come in for short term. The ATO are looking at, you know, ensuring people are claiming the right private or the right business or income producing portion, and we're apportioning correctly for private use.
Yeah, that's certainly an area that's probably been a little bit grey in the past, and I guess a bit slippery for some people where they might be prone to claim some deductions that they probably shouldn't be.
Absolutely.
Okay, cool. That's a really good tip because we are seeing a lot more Airbnbs and those short-term rental properties pop up on the market, and people even buying, you know, they'll rent a property out, they'll lease a property and then sublease that out as an Airbnb. So we're seeing that quite a bit. So, okay, cool. And what else do you think the tax department might be happy to look at this year?
In 2017, you know, they brought in the rule that you cannot claim any travel to your rental property or travel associated with maintaining your rental property. So they're definitely going to keep an eye out for ensuring people aren't claiming travel.
Yeah, that's a pretty big one.
Yeah.
We get a lot of clients that spread their risk out by buying interstate. Previously they were, I guess, having not a free holiday, but claiming travel to the destination. Happened to be in Queensland, so they went during winter and experienced some nice weather. Yeah, but that's changed.
Yeah, it has changed. So, you know, airfares, accommodation, meals, they were the sort of expenses people were claiming, and a lot of the properties happen to be in Queensland. Became a little bit overclaimed, I would say, and so the ATO proceeded to say, well, no travel.
Yeah, that's a good tip. Yeah, that's another one that might get a few people unaware. So yeah,
and definitely ATO are looking at and targeting people who are maybe continuing to claim.
Yep, cool. Okay. Any other tips that you think the ATO might be keep an eye on?
Simply, you know, overall expenses. You know, making sure you're keeping substantiation and proof of the expense. So, you know, there's 3 rules associated with an expense being an allowable deduction. The first one is that you needed to have incurred the expense yourself. The second rule is it needed to be directly connected to earning your rental property income. And the third rule is you needed to be able to prove that you incurred the expense. So the easiest thing is just to keep your receipt or your invoice. That's going to be the best way. They will accept credit card transactions and bank transactions, but the best thing is just to keep your invoices and your receipts.
Great, thanks. Okay, Michael, just one thing I wanted to ask, which I get a lot of clients ask me about, and with their strategies of buying property in self-managed superannuation funds, a lot of people are under the impression that they can use that as their holiday home or for their own private use. Maybe get you to talk about that, please.
Yeah, sure, Adam. Unfortunately, with a super fund, its main purpose is to provide for your retirement, and investments that you purchase within your super fund has to exclusively meet the purpose of doing that. And there's very, very strict rules around being able to use any asset within a super fund personally. So definitely a no-no to be able to use any of the assets, such as a holiday home, yourself in any percentage, unfortunately, or related party. So yourself or related party, which includes, you know, family, friends, anyone that is close to you, won't be able to use the property in any way. Okay,
and that's even post-retirement. So say I wanted to buy a property myself managed super fund now down on the coast, and I think I'll go and retire in that. Is that not allowed?
No. If it's within your super fund, so related parties and yourself won't have the benefit of using it. Unfortunately, the strategy I think most people have is in retirement they sell it or transfer it out of the fund into their personal name, which obviously involves a cost, stamp duty and possibly CGT, but that's a different strategy. But yeah, if you want the benefit of using it yourself, it must be outside of the super fund.
Yeah, okay, cool, thanks. Okay, you previously mentioned that there are some expenses that you can claim for your investment properties, and we touched on just interest on a loan. So you've got a pretty detailed list there. Do you maybe want to run through some of the additional things that we can actually claim where people may not understand they can claim this as a tax deduction on their rental property?
Sure. Interest is by far probably the largest expense, interest and depreciation. But I'll run through a list of other possible deductions. It can be any expense, but the main ones I'll run through a list. Advertising for tenants, bank charges. Now bank charges can involve establishment costs. So when you establish a loan, there's establishment costs. With establishment costs, they're deductible over 5 years, so amortised over 5 years. There are also other costs such as mortgage insurance, which some of you may be required to pay. That's deductible over 5 years as well. And of course any other bank fees along the way can be claimed along the way. For example, I know some banks charge a one-off package fee, annual package fee. That's a deduction each year.
Can I just clarify then there?
Sure.
So two things. So one, that annual package fee. If you're refinancing to restructure your loan to actually buy your investment property,
yes,
and the loan you're restructuring to as a result of that has a package fee, you can claim that as a tax deduction.
Correct.
Okay, that's good news. The other part is mortgage insurance, where if you're putting less deposit in for the purchase of your investment property, and the bank makes you pay mortgage insurance, you can actually claim that as a tax deduction.
You can, but
so that writes off over a 5-year period.
Correct. The same as establishment costs.
Yeah. Okay.
So they're usually a one-off cost. So it's 5 years. It's the lesser of the two. It's either 5 years or the life of the property. So if you sell the property in 2 years, well then you can write off the balance of those expenses in year two. Yeah.
Cool. That's handy to know because a lot of people don't like to pay mortgage insurance. But if that's something that helps you to get into your investment property sooner, or maybe keep some more funds in reserve for a rainy day like we've seen with COVID where everyone needs some funds in reserve, paying mortgage insurance, although it can be seen as an unnecessary expense, but you can also write that off on tax over those 5 years. So if that helps you move forward, retain some funds in your war chest, you've got that buffer in place, probably not a bad strategy in some cases for the right people.
Correct. I mean, to get into the rental market, if you're a high income earner and potentially paying, the highest marginal tax rate of 47 cents on the dollar, your mortgage insurance effectively becomes almost half the cost of the initial outlay. So it certainly helps people enter the market.
Yep, cool.
And it helps to fund the costs associated with rental properties. But other things I've got listed here, general cleaning of the property. If, for example, for those Airbnbers and holiday rental properties, regular cleaning is, or any sort of cleaning that you engage with on the property is deductible. Council rates, electricity and gas used by tenants that you're obligated to pay as a landlord is deductible. Gardening, lawn mowing, in-house audio-video service charges such as internet, if you've included that as part of your package to your tenants. Insurance, now another one, so building insurance is definitely a must in a rental property situation, and the second is landlord insurance, where people will take out insurance for malicious damage of property caused by tenants.
That's a big one to have, landlord insurance. And one thing I always say with insurance is don't always take out the cheapest insurance policy. Again, it's tax deductible. Get the right insurance because you'll only know you've got bad insurance when you go to claim and you can't make a claim.
So definitely look through the fine print. There's even loss of rent, for example. Whilst you're going through an ordeal, it might be 3 or 4 or 5 months before the property gets back on the market for you to be able to put a tenant in. A lot of those good insurances cover you for loss of rental income. Land tax is another expense. Legal expenses, that you might incur for preparing leases, they're deductible.
So that also goes down to your conveyancing for the transfer of the title from the previous owner's name into your name?
No, so that's a different legal cost. So that forms part of capital. So the conveyancers costs, so the purchasing of the property, costs associated with purchasing of the property is of capital in nature and will only provide a deduction against a future capital gain when you sell the property. But
okay. So
if there is like you mentioned earlier, a sublease arrangement or even a lease arrangement, I haven't come across too many residential lease arrangements, but if you legally get that prepared by a conveyancer or a lawyer, it's tax deductible. The fee is tax deductible.
Okay, cool.
Yeah. Pest control, regular pest control, most people want to make sure their property is protected against pest. That's all deductible. Mortgage discharge expenses. So if you're lucky enough to get to a point where you pay out your loan on your rental property, there is a discharge fee. That's deductible in the year that you discharge your loan. Yeah, security charges. If you've installed some monitored alarm systems in your property, that's deductible, and just general stationery bits and pieces that you might incur expense on, telephone, in maintaining and managing your property is deductible. They're pretty much the most common deductions and expenses that are claimed against rental properties.
Okay, so it's a pretty big list.
Yeah.
So I guess there's a lot of things you can claim as a landlord, and there's probably a lot of things that you've gone over that people aren't claiming. So best advice is if you're doing your own tax, don't do your own tax for a rental property. Go and see an accountant.
No, I thoroughly recommend that you do get some professional advice, and definitely if we can be of any assistance, feel free to give us a call at the office here.
Yeah, and that's one thing we say to all of our clients. Again, it's like we said about getting cheap insurance. I think the same with the cheap accountant. I used to be a finance broker, and I'd see tax returns coming back for my clients that had rental properties with huge holes in them because they'd got a cheap tax return done but wasn't by a property investment specialist who understood all of the little bits and pieces that you want to claim against the property. So again, that's something you just can't skimp on, as having that right person in your team to do your tax. Yeah. So great.
Certainly agree with you there, Adam.
Excellent. So with the current COVID situation, obviously we've seen a lot of people working from home. Can I just get you to run through some of the tax deductions which may be available to people who have and are still probably working from home?
Yeah, so the same principle will apply to people working from home, managing their rental property. So effectively the government is allowing an unsubstantiated rate of 80 cents per hour applicable to time spent in managing your property. So the simple thing is to record the date and time you spend managing your property, or possibly on the phone chasing, managing things that you require to make phone calls on, or possibly spend time in direct relation to your rental property. Just record the date and time, and we can use the 80 cents per hour unsubstantiated rate. That will incorporate the use of home electricity, telephone, and internet costs.
Okay, so we talk about claiming depreciation along the journey of being a property investor. What are some of the considerations when we go to sell the property?
That's a great question, Adam, because what you're actually doing with depreciation is claiming a portion of your capital expenditure, the initial cost of your property, as you go along. So what that means when you come to sell your property, you'll know how much you initially bought it for, and obviously we all know capital gain or loss is the difference between how much you sell it versus how much you purchased your property. The amount that you purchased your property is called the cost base. So your depreciation along the way reduces that cost base. So if, for example, you bought a property for $500,000, 500,000, and 10 years later you sell it for $1 million, let's hope you all do, then the difference in those two cost bases is $500,000. However, if you've claimed depreciation over the last 10 years that totaled, say, $100,000, that cost base of 500 gets reduced to 400. So your difference between 400 and $1 million is the capital gain. So the capital gain gets increased effectively by the amount of depreciation you've claimed along the way. So yes, it can't be claimed at both ends. So if you're claiming it through the life of the property, you won't also be able to claim it at the end when you're calculating your capital gains.
Okay, that's a handy tip to know as well, because not a lot of people would know that. So, great, thank you. Okay, so that's been a great chat, Michael. So, Michael Zarella from MasterTax at Norwood in South Australia. Thanks very much for coming along, and if you want to get in touch with Michael, you can contact the office or contact me and we'll put you in touch. Certainly a tax specialist when it comes to investment property. So thanks for joining me.
My pleasure, Adam, and thanks for the invitation to have a chat today.
Great, no worries.